Hello and welcome to the show today. I'm really glad you could join us. So today we're talking about how to maximize your financial potential. We're talking about some interesting things you probably haven't thought about to be able to maximize your financial potential. It's the things you need to be doing now to be able to do so. With us today, we have two special guests. First of all is Rachel Marshall. Now, she's a co-founder and chief financial educator and content strategist of The Money Advantage. She is known for making money simple, fun, and doable. And she's currently writing a book about her near-death experience. We've got to ask her about that and how it became the springboard for her family's multi-generational legacy of more than money. And Bruce Wehner, now he's the lead advisor of The Money Advantage, where he designs and communicates the individualized solutions that help their clients increase cash flow and give more financial control. Now, Bruce leans on his experience as an educator and varsity head coach, lifelong entrepreneur, and real estate investor as well. And he's a Nelson Nash Institute authorized infinite banking practitioner who is practicing infinite banking since his parents started his first policy when he was a young child. There's no way I could say that 3 times fast. I just
that was pretty good, actually.
I was trying.
That was awesome.
First time was okay. Second, third, we're not. So Bruce and Rachel are also the co-hosts of the Money Advantage podcast, a popular business and personal finance show. Both of you, welcome to the show today. I'm really glad you could join us.
Awesome. Thanks, Ty.
Boy, Ty, we do a lot of these, and I love the energy. It's the highest we probably have ever had on a podcast. So thank you for doing that.
Well, I appreciate it. If I could bottle this and sell it, I would be a quadzillionaire. If that even.
Oh, yes, you would. Yeah. Awesome.
So I love it. So, well, first of all, I was actually going to ask something else, but I'm interested. So how is your podcast? So you've got a really popular podcast. How is that going? And what do you cover in your actual Money Advantage podcast show?
That is awesome. We started about 3.5 years ago, I believe, maybe 4. And we talk about how to really maximize your money, how to keep more of it, how to protect your money, and then how to turn it into cash flow through assets. So this is really, if you boiled it down, it would be cash flow and control. We teach entrepreneurs and business owners and people who really are entrepreneurially minded to have cash flow and control. Those 2 words are key.
So let's start there. With cash flow, what do you mean by cash flow?
So, the entire financial services industry, I'm not saying every individual is not doing a good job because they're trained by the industry. I blame the industry. And the industry has actually adopted this whole idea of appreciation. Give us your money in a systematic way. We'll take it out of your paycheck or we'll take it out of your checking account in a systematic way. We will hold it for 40 years, and then we will hopefully appreciate the value and then trickle it back to you. So you're giving up complete control of that, and you have no cash flow along the way. So we've kind of flipped that model and said, what if you were to invest in things along the way that were income generating instead of things that are only hopefully appreciating in value? And that way you build your wealth on income generation. The one that everybody focuses on nowadays is real estate. Of course, not everybody wants to deal with tenants and toilets and all those other things, but there are some really neat things that have come out into the market as far as turnkey investments or syndications that you can actually just hand your money over to proven people that have done a good job in real estate. And if you don't want to do those kind of things, you can actually get with a person and you can actually get invest in other type of private equity or private investments. Ty, a lot of people don't know this, but the people that know about wealth are actually flowing more money into private investments than into the stock market right now. And one of the reasons for that is they feel like they have more control over actually talking to and meeting the managing partners of these things. I tell people all the time, I can't contact the CEO of Coca-Cola and ask him what his philosophy is to grow the business and maintain the dividend. But with these smaller private equity, private investments, master limited partnerships, I can actually sit in a due diligence meeting with the managing partners and look them in the eye and talk to them and ask them what they're going to do. They share their books with me. They share their upcoming investments with me. And so that is control in my mind. And that's what we like to help people do.
Yeah, I see the syndication thing as where it's going. Like I'm in a part of a mastermind, and next week I'll be there, 10 million, $1 billion plus companies. That's what they're all doing. Like they're not putting money in the stock market. It seems like they're giving money to other people that are very wise at what they do, real estate investors, whatever it may be. And then those people are then using that money, and then they're getting a rate of return. And almost everybody I talk to that has wealth is all doing exactly what you're describing.
Mm-hmm. Yeah, it's very interesting. The principle is control, right? If you're in a position of saying, well, I'm just going to give my money to the stock market, which we have no guarantee is going to go up. I mean, everyone talks about an average rate of return, which average is not the actual rate of return. And if you lose money in the stock market, you have to make much more than you lost in order to compensate for that. And unfortunately, we're just all told this same status quo story. Just stick your money in the stock market, leave it there forever, let somebody else be in control of your money, and you just hang on for the ride and hope it all works out and hope you have enough money to drain off the income and not run out of money before you die. If you have a long life and maybe your lifespan and your life expectancy is longer than expected, what do? You're not in a situation of control. And that's why we want to say, have money in your control, be in a position where you know what the future holds, the rate that your money is going to earn, or the guaranteed amount that you're going to have in the future. You're in a position where you own and control that capital. And then you're in a position where you're trusting people like Bruce is talking about as well. And you're in a position there where you're investing with knowledge and control. You're not just hanging on for the ride. It's not a passive income.
And I guess that's what I need to understand more of is control, because it seems to me like whether I put my money in the stock market and, it's anybody's guess of what's going to happen, or I give it to somebody that I trust, know, and is going to invest it in their thing, let's say real estate, I'm still giving it to somebody and kind of giving up that control, it seems like. So when we talk about control, what do you mean by actually controlling it? Because no matter where I move it, if it's not me directly investing it and controlling what happens to it, then whoever I'm putting it with kind of seems to have taken over control at that point.
Yeah, that's a very good, Ty, and that comes up a lot. And you have to, there's different levels of control. That's obvious. But if you start out, and Rachel will touch on this in just a second, if you start out with actually controlling where you actually store your money before you invest it, then that actually helps you mitigate the risk of the lack of control going forward. But you're absolutely right. Even if you get into a syndication, you're giving up some control to somebody else. But our way of thinking is that control is a lot easier to digest because you are actually controlling who you're working with directly, not by putting it into a stock and not being able to necessarily determine. Now they're going to say, well, you can vote on the board of directors and so on and so forth. So you have some control and you can pull it out and go take it somewhere else. You have some control. But we believe that it's the knowledge that gives you control. So the more knowledge you can have for yourself personally, and more knowledge you can have with the people that you're actually investing with, that is a feeling of control.
So it's the knowledge. And then also what I like to think of is this an alternative investment? And now the stock market is not completely evil, but at the same time, when I think of riding the stock market roller coaster, hoping that the whole thing continues to rise and, just crossing my fingers and hoping the economy improves and hoping that the companies I'm invested with or whatever fund I'm in, hoping that goes up, I'm not in a position of control. But if I can be in a position where I've separated, there's a line between stock market performance and what I'm doing over here. Maybe it's in the real estate industry, or maybe it's somehow else that's not just automatically going to rise and fall with the tide of everything else. And I'm in a position where I have knowledge, or I'm investing with somebody who has very clear, specific knowledge in that field, then I'm increasing my control. And anytime you increase your control, you lower the risk.
It's really interesting that we're having this conversation at the time we are. I just finished Grant Cardone's 10X conference. And then
nice.
In part of his back office, he had a financial management system, and I just fired it up. And I literally was just listening to it as I went into this podcast, and he preaches the same thing. He's like, listen, these people have got you brainwashed that you're going to put money in for 30, 40 years and then, eventually make it. It sounds like what you're saying is that you get the money, but then you need to take that money and invest it in areas that are really going to get you the rate of return, not put it with the banks, not put it in stocks where maybe it'll turn on. And I get that because my mom and dad are the same as a lot of people, right? They put their money in the stock market. And now, when things crash, in retirement, man, it's all about timing. If it's down, they are in
Yep.
a really bad place, right? And they could be in that bad place for 10, 15 years of their retirement. It just seems like such a sketchy, crazy thing that people do with their
Oh,
money.
it totally is. It
Right.
totally is. And
Yeah,
what's interesting, sorry, Bruce,
That's all
what's
right.
interesting about that as well is if you, for the most part, most people don't actually invest for 30 or 40 years. They get to 50 and then all of a sudden they're saying, oh my goodness, I haven't done any retirement planning. Now I need to save money. I haven't had enough to be able to save, to put into this system of accumulation. And so then they start kickstarting the program. But really, if you look at this, and I mean, I'm not going to pull up a whole illustration right now, but if you said, well, let me try to put in $50,000 a year, every year, I'm going off numbers that I just calculated yesterday. If you put in $50,000 a year for 15 years, from age 50 to age 65, and you said, well, I expect this is going to be a 6% rate of return, which means it would have to be a guaranteed 6% every single year, no losses, nothing less than 6 ever, which we know is never going to actually happen in the real world. And so if that happened, you'd get somewhere over about 2 million. The problem is, if you wanted to live on a $50,000 lifestyle, which people, to my knowledge, usually want to live a lot better than that, but let's just say at 65, I want a $50,000 a year lifestyle, I'm going to have to deal with inflation by the time I get there, and I'm going to have to take out more than 50,000 to make it feel like what today's 50,000 lifestyle is. And that money, if I live at a 50,000 lifestyle, is going to be used up. I think it was by like age 78 or something like that. And okay, so the deal is, that's if you put aside $50,000 a year to get a $50,000 lifestyle. The crazy thing is that it takes way more money than you think to put aside to do that. You have to have way higher accumulation than you think in order to make that work. And really, it's not working for anybody, but we all still try to do the same thing.
It makes sense. And it sounds like, so now where do we put the money? Because it sounds like the idea is to make it, and then instead of saving it in long-term things that, maybe will, like you said, will have that end result, which isn't good, then we want to reinvest it in things that will get us a rate of return in these syndications to other places. But like, I don't know how to do that. I'm running a business, right? So like, I don't know the safe places to put my money. So how do I figure that part out?
That is an excellent question. Bruce, do you mind if I take this?
No, I was expecting you to take it.
Awesome. All right. So here's the deal. Nobody can just make money and invest the money, make the money, invest the money. That's skipping a giant step that most people try to just do exactly that. They make the money, they invest the money. They're skipping over the protection component. It doesn't matter how much money you make, that will never make you wealthy. It doesn't matter just how much money you make in investments. That will never make you wealthy either. It can all be lost. It can be evaporated. It's not a situation that you can't just make money and invest it. You need to be in a position of protecting that money. Now, this is the very, uncool, unflashy, unsexy part of financial management, but you need a cash flow system that actually works. Whatever money you're making and keeping, you need to protect that money, because here's the thing. If any one life event can come in and rob the wealth that you have built and make you poor, you're not really wealthy. So you need a place to store and house your capital in between making money and investing money. Does that make sense so far?
Yeah.
Okay. So that place of storing capital, this is your cash flow management system. This is saying, how can I keep as much of the money that I make as possible? And that's a whole nother conversation about maximizing your income and making sure that you're spending as little of it as possible without crimping your lifestyle. But then we're in a position of saying, now how do I protect my capital? I need some place to warehouse my wealth, to build a reserve, to hold my capital that I can use. And I need it to be safe. I need it to be liquid, and I need it to be growing. If you leave out any one of those three things, you're really almost hamstringing yourself. You need it to be safe, because I can't store my cash in a place that it can just poof, be gone tomorrow. I can't depend on that. That's not the point of protecting my money. I can't store it in a place that's earning only 0.02% in a bank account right now. It's not going to keep up even with inflation or do much for me. And I cannot put it in a place that's going to be locked up for the rest of my life until I'm 59 and a half, and I can't get to it unless I want to pay taxes and penalties. I can't have it locked behind bars. I need to be able to get to it. I learned this personally when I started in business. We had our money invested in gold and silver, which you'd think, okay, long-term store of value, super great investment. However, we were not thinking of liquidity. And the reason that it really kind of blew up in our face when we needed cash, we realized that the price of our asset we'd invested in was about half of the value of when we had purchased it. It was not the ideal time to take money out. That's not a position you want to be in. You need money that's liquid and available. So when I think about, I need a store of capital that's safe, liquid, and growing, the best place that we've found is privatized banking. Now, this is also called infinite banking. It is using a product and a strategy. This is a product of whole life insurance that is dividend paying with a mutual company, specially designed for maximum early cash value, and then using that cash. So I talked about protecting your cash and holding it in this reserve. Now I need a way to utilize it. And now I can borrow against that cash and put it to work in my investments. So this is the perfect holding tank in between making money and investing that money. It's the storage tank in the middle.
So let me ask you a question. Have you ever heard of Curtis Ray?
The name sounds super familiar.
Okay. I asked that because, a lot of people that I've talked to say the same thing about whole life. When you even mentioned a place that's safe, it's the first thing that comes to mind. I'm like, whole life, because you can get a loan against your actual policy and use it for investment. So, and then this is what it sounds like you're saying is you grab a whole life policy, for example, put your money in there, and then you can actually take a loan against that whole life policy, which you very low interest, like 3%, 4%. If I can off the top of my head.
It depends on the company. Yeah.
Depends on the company. And then you invest that into things that obviously get you 7, 8, 9, 10% return, right? Is that the idea of privatized?
Yes.
Is that what we're looking when we talk about privatized?
Absolutely.
Yes. You're taking the banking function into your own control. So I always tell a person, think about our banking situation. And we need banking system. We need a public banking system to do transactions, amongst each other.
Sure.
Now, maybe Bitcoin will change that, sometime down the future, but right now we need it. But think about that. Banks don't need our money anymore. They used to need our money. They used to entice us to bring money to the bank by having an interest rate that's greater than the interest rate down the street. But ever since the 2008-9 financial crisis, and the Federal Reserve has basically said, here's all the money you banks you need, just get it from us. So they've driven down interest rates because they don't need to entice us to bring money to the bank anymore. So they give us hardly any return, like Rachel said, 0.02. And I think that's kind of generous sometimes. And then they use our money to actually lend out to people in, maybe a 4% car loan or a 3.5% mortgage. And people think that's only, let's just say they give us zero return because it's easier math for that. And they get a 4% car loan. People say, well, they're making 4%. Well, they're not. They're making 400% on that particular money. And so they're really maximizing that. So if you can do that in your own personal life, if you could borrow money at 4% from your policy and make 12%, like you were talking about, Ty, in an investment, a syndication, well, then you're making the 300% return on your particular money. And as Rachel has mentioned with her book, you're protecting your family, you're protecting your business, you're protecting your loved ones in case something happens to you personally and you die. Because now they have a death benefit that can complete the wealth building process. And this is often overlooked and poo-pooed by, financial experts all the time. Oh, well, you don't need to buy life insurance. You just need to have enough assets that will protect your family. Well, that's great if you get to that point. But as Rachel had a near-death experience with her second child, and I haven't had a near-death experience, but I lost my complete home to a fire in 2014. Everything I owned was lost, but I had great protection on it. And so financially, we did not lose. That's what insurance companies do. They protect our wealth. And they're really good at doing it because that's all they do. So if you don't have protections in place, whether it's life insurance or your business liability insurance or your personal umbrella, all these things, you're putting your wealth at risk. And the uber wealthy people do not do this. They start with protection.
Yeah, it's really interesting because there's a thread through this of becoming your own banker. And I'm sure that you've heard this before, but I just wanted to highlight this idea. The bank holds our capital, makes arbitrage on that money by earning more than they pay for the cost of that capital. they earn interest, and they're in a position of control. We can do exactly the same thing in our own financial life. Instead of just handing the banking function over to the bank so that they have all of the profit and the leverage and the cash flow and the interest and the control, we can do that in our own life by taking over that banking function. We store our capital. And the reason we talk about infinite banking is because it's the most powerful tool that we've seen to do this, to be able to store your capital, earn interest, earn more than you're paying for the cost of that capital, and be in a position of uninterrupted compound growth. That's where you get the interest that you're earning. That's where you get the control. That's where you get cash flow. That's where you're in a position of saying, even if I just leave this product on the shelf and I don't use it for anything, it's still going to have cash flow that I can access, and it's still going to have a death benefit. But it's even more powerful when I start using it. And that's because most people bypass this idea of having savings. We think earn money, invest, earn money, invest. We want to earn, save, and invest. Now, I don't mean save instead of investing. And this is something that I think is really, really crucial to hear. If we save first, and we don't think of just a rainy day fund, I don't think of I'm just saving for a medical emergency, or I'm not just saving for a car that I want to buy next year, because that's really just delayed spending. That's not actually true savings. But instead, I'm thinking of savings as an emergency and opportunity fund. Now, there's so much potential with this, right? Because I can say, well, this savings can be used for anything, literally anything. I can use it for an emergency. I can use it for a medical expense. I can use it for a down payment on a house. I can use it for a rental property. I can use it for, to buy another business. I can use it to pay for a marketing strategy in my business, or to expand a different line in my business, or whatever. You and I both know that there's a million business expenses that you can have that will grow your business, pay for a mastermind. Now, anything that's an emergency or an opportunity to increase your cash, now I'm thinking I've saved this capital and I own it and I control it. Now I'm in a position of using that to make more money. And that's the most powerful advantage of using life insurance, because now I can borrow against it, put it to work in an opportunity. And here's the thing, I don't give up earning inside the savings tool. I keep earning inside the savings tool while that money is working also in an investment. So my money is doing two things at the same time, because I'm still earning dividends and interest on all of my cash value, while that same money is being used over in an investment, rental property, whatever it could be. And so that is the powerful strategy to really say savings is important. Protection is really important. Building up savings that I can access and use, having capital in my control. Now I can be the bank. Now I can earn more on my investments. I can boost my investment returns. It's even safer than just investing, because I have the fallback of the death benefit if everything falls apart with the investment. I'm in a much safer position. And from that safe vantage point, it's kind of like the mountains you can see behind you here, but you're on that peak. You're in a position of saying, I'm in control, and that control gives you confidence to make better decisions.
Yeah, it's really interesting because a lot of people don't even understand the concept of a bank. And that's how banks are big. Chase, Bank of America, look how big these guys are. And they're big because they literally take our money and they invest it, and then they get all the returns and we get nothing. And people don't even understand that concept. It's kind of mind-blowing to me. So with this being the case, how do we know what kind of policy to go for to get life insurance? Because there's a lot of options out there. So give us some guidance of what kind of insurance policy we're looking for with whole life, to be able to park our money to keep it safe, to then be able to borrow against, to then be able to reinvest or use.
I'm going to say something first before I hand off to Bruce to answer that question. I think the first question that sometimes people say is, well, what kind of policy do I need? And then what can be really easy to do, though, is to say, okay, well, here it checked all the boxes, the 28 or 18 steps that I needed in this policy. And now I'm going to take my shopping list and I'm going to go say, all right, who am I going to talk to get this exact policy? Oh, they missed 3 of the boxes. Oh, I guess they're not the right ones. Let me go try somebody else. They don't have no idea what infinite banking is. All right, let me tell them what infinite banking is and hope they'll get all these boxes. The challenging thing is you really need to be working with somebody who understands fundamentally that you want to be in control, because anyone can design an infinite banking policy if they knew everything up front. But really what you want to do is be working with somebody who understands where you are going, who you are, what you have to work with right now, and is really like-minded and understands your goal for cash flow creation and creating passive streams of income and multiple streams of income from assets. So I just want to put that caveat first, because it doesn't matter if you have the perfect policy. If you're not working with somebody who's like-minded to really understand where you're trying to go, it's going to be really challenging to start from checking all the technical boxes to make sure it's the right policy. Does that make sense?
Yeah, makes perfect sense to me.
So,
all right, go ahead, Bruce.
So Ty, Nelson Nash, the inventor of the concept, because you have to use a product to implement the concept or strategy. He has some guidelines, but they're only guidelines because we do have to sit down with each individual person and figure out what their goals are. But the basic concept is you need to use a mutual company. Why? Because policyholders are part owners of the company when it's mutual, and they get the return of the investments from the company in the form of a dividend. Dividends are not guaranteed, but all these companies have been in business for more than 100 years, and they have paid dividends even through the Great Depression and the Great Recession. So talk about safety. These companies know how to handle people's money. Then you really have to look at whether it's a direct recognition company or a non-direct recognition company and how you're going to use that. And that's simply how they recognize whether you take a loan against a policy, how they're going to pay dividends to you. And then you have to look at, I believe, their financial strength. We just recently in the industry had one of the mutual companies actually demutualize and will become a stock company. And that's not the end of the world, but it actually changes your strategy and how you're doing it. So you better be working with one of these companies that has a very high level of financial strength. And then the final thing is you need to have a company that has great customer service, because a lot of these older mutual companies, it was kind of the appreciation model that we were talking about at the very beginning of just give us your money. We'll wait till your retirement age, because a lot of people use this as passive income in retirement. And then we'll give it back to you, so that they don't have the systems in place to do these loans and loan repayments and so on and so forth. So it's really important that you have a company that has really good systems in place, because when you want to take a loan and go into this syndication or this other opportunity, you want to get to your money. Nelson Nash used to say, opportunities find money. And that's true. I bet you find that in your own business, or your own people that you know about that have money. All of a sudden, a great opportunity comes because they have access to cash. They can jump on that opportunity. And that's what Rachel was talking about, is having this opportunity fund that you can jump on and take advantage of.
And actually, to piggyback on that real quick before we go to your next question, and I'm sure you're probably close to wrapping up here as well, but the idea of using infinite banking is you're driving this policy. I like to think of it as either sitting on the shelf, meaning I put my money in, I pay my premiums, I do nothing with it until I die. Then my beneficiaries, maybe it's my kids, maybe it's my spouse, maybe it's a charity, maybe it's another organization, they get the death benefit. That's sitting on the shelf. That's a product that we just have as like a wallflower. But instead, I want to take this policy out and drive it. I want to use it in my daily life. And what that looks like is taking the policy loan, using that for an opportunity, and then paying back the loan. And the cool thing is you're guaranteed the access to the policy loan because you have cash value. So if you have $100,000 of cash value, say, well, I need to use a $75,000 for an investment that I want to take advantage of and I want to jump into right now, you write a request to the insurance company and they send you a check. They don't ask, what's your credit score? They don't ask, how are you going to repay this? What are you using it for? Let me approve. Let me check all the boxes. There's no big paperwork. There's no qualification process. They give you a check. And then when it comes to repayment, yes, it's going to accrue interest, meaning that as you're paying on this loan or not paying on the loan, the longer it's outstanding, you're going to accrue interest, but you don't have a fixed repayment schedule set by the insurance company. So you can say, well, this is a flip situation with whatever I put my 75,000 into. It's a house that I bought and I'm going to have all this capital infusion. I'm going to fix it up and I'm going to flip it and it's going to make me 150,000. Then I can repay all at once with one big chunk. Maybe that's 3 years later. I don't have to pay on a monthly schedule. I don't get dinged or penalized in any way for paying late or not paying at all. And the cool thing is, I think we mentioned, but we might have glossed over that when you take a policy loan, you're not taking your money out of the policy. You're borrowing against it. You're using your cash as collateral. And so you're in a position where you're collateralizing this cash value and you are continuing to earn money on that money. So I just wanted to clarify that.
Makes sense. What about where you put the money? Because like you said, as I've accumulated wealth, everybody, like I have all these opportunities coming out of the woodworks. It's insane to be able to put my money to get positive returns. But it was never like that before I accumulated wealth. So how do people know then, we talked about the cash flow part. We talked about the protection piece. How do they know what's just the right opportunity to then really invest? I mean, they have a choice now, but the question is like, what do they choose?
That is really good. And I think there's multiple parts to this. And so I'll jumpstart it and then Bruce, I'll pass to you. So I want to say the first thing that you want to think about is knowledge and control. So I think opportunities can pop up everywhere. And all of a sudden, here's a good opportunity. Here's a good opportunity. And this one is 100% rate of return. And this one's 60% rate of return. And this one's we can look at just the math and the numbers, but really you want to look at what is something you control, meaning that you have the ability to influence whether it increases in value or decreases. You have an exit strategy that you can get out, meaning you can liquidate if you don't like how it's performing. And you're in a position where you have knowledge of that investment, or you're working with somebody who has a proven track record of knowledge in that investment. So just because it's a good investment does not mean it's a good investment for everyone. Bruce, I'll pass to you on that.
Well, I would say you mentioned Grant Cardone, and I believe he would endorse this thought too, because many of the people that are 10X type people, including Dan Sullivan, would do exactly what Rachel said. You need to kind of stay in your lane, learn about a certain investment classification and stay in that lane so that you can make decisions quickly and figure out what's a good deal and what's not a good deal. Doesn't mean you have to not go outside of that for diversification every once in a while. And I would caveat that is there has to be a certain level of comfort with lack of liquidation. It was proven during the COVID situation, as the stock market was crashing, people in these private investments that weren't as liquid as others, that was actually a tremendous benefit because it couldn't be a run on that particular asset class. And people could take a breath and say, oh, we can actually look at this in a long-term situation, and I'm not going to hamstring this asset class by pulling the money out of it. So you have to have a balance between liquidation, which is total control, and lack of liquidation, which might not be total control in some people's minds, but in my mind, it actually helps the asset class. So you are in more control of that because you're in more control of the volatility of that particular asset class when you can't liquidate the entire amount at any given time.
Makes sense. Where can everybody go to learn more from you too?
Awesome. Thank you for asking. We have a wealth of information and knowledge at themoneyadvantage.com. I'll tell you real quickly about the quick and easy privatized banking guide for investors that we have that I think your audience would probably be most interested in. And they can find that straight on themoneyadvantage.com. You can also go to privatizedbankingsecrets.com. Now, this guide is a video course as well as a download. And really what it does is it helps you to understand what the fundamentals of using infinite banking are and why I would use it in the first place. And especially, why in the world would I possibly use this thing instead of just earning the money and investing the money? We go through an actual example of investing in a very, very simple one single family home as a rental property and what the returns would look like if you just earned the money and invested, what those returns are, versus if you take that backward step that gives you so much more power in the long range view and said, let me protect this cash first and put it into an infinite banking policy and then borrow against that policy to use the money in the investment. And I'll give a little spoiler here because it's so good. It's not just boosting your returns by a little, it almost doubled the profit in this particular situation. And that was just by taking a step of saying, let me not just go straight from making the money to what's the best investment and investing the money. Let me really think about that protection component because it's way more powerful than you would think at first glance. And so putting the money into the insurance policy first, borrowing against it, this guide walks completely through that, shows you the bare bones, the nuts and bolts of exactly how this works. And it's not overwhelming either. It's not the deep dive on policy illustrations. If somebody wants that, they can get our course, they can deep dive into our podcast series. We have a wealth of years and years of tools and resources that they can access. But that guide is really a first jumpstart, quick start guide if somebody is interested in finding out more about privatized banking.
Sounds good. Thank you to both for coming on with us today.
Thanks, Ty.
Awesome. Thank you, Ty.
So listen, you know, this is the formula for success, really, in maximizing your money. And if you hear a lot of financial gurus, they don't talk about these principles at all, but they do talk about the foundational principle of whole life being where you can protect your money. But then it's about using that money and really investing it in a way you can get radical returns, which is what both Bruce and Rachel have talked about today. So make sure you visit themoneyadvantage.com. Themoneyadvantage.com, there's a ton of stuff here. First of all, you got to check out the picture on the home screen, because I thought these people were skydiving. And then I'm like, how are they skydiving with sunglasses? And then I realized they're not skydiving. So
You're the second person who said that. We might need to make some modifications.
No, it's great, because now I can say that. And now everybody listening is like, I have to go see the pictures. So they're all going to go check out pictures. And see
Love it.
So there's a lot of stuff here. They can access the podcast, but make sure you grab the guide. There's a button right in the middle of the homepage. All you do is click the button and probably imagine enter a little bit of information and then grab this guide. This guide is the map. It's the roadmap. It's the formula of success. So make sure you do that. Privatized banking training here. A lot of other stuff about investments, a lot of other education training. Take us a deeper level. We just scratch the surface here. So make sure you go to themoneyadvantage.com, themoneyadvantage.com. Make sure while you're there, you click the button in the middle of the screen to grab this guide and get the roadmap to be able to be successful here. And then you can actually start generating cash flow, or have a cash flow you have, actually protect your money and your family. And then at the same time, start earning radical returns on your money instead of sitting in a place where it doesn't earn any. If you want to earn the guide, if you want the roadmap, make sure you go to themoneyadvantage.com, click the button in the middle of the page, grab the free guide. Again, that's themoneyadvantage.com. Thanks for tuning in. Have a great day.